Okay, good afternoon, everyone. So we are going to continue our first chapter. That means we are going to learn how to determine the price of a target company. So you are targeting to buy one company, then you should do some calculation by yourself. What should be the price? Do you understand? Now, can you remember what is the formula? How to determine the price? So how to determine the price? What is the formula here? Can you remember? So it is something like equal net assets. So you are going to buy the net asset of the company, right? Plus you are going to buy their goodwill. So this is the formula to determine the price of a target company. Any question from here? So first we have to calculate net asset, then we have to calculate the estimated goodwill, but to do so, we have to follow some steps, right? We have to follow some steps. And what is the first step about? We are going to determine the return on asset. And this is given in the question. Why? Because it is easy to get the information. For example, you are targeting to buy a manufacturing company, or you are going to target to buy a service company. So what you can do, you can go to the market and you can search what is the rate of return for the manufacturing company. What is the rate of return for service company? Something like this. So this is quite easy to get this information. And whenever you will solve a question, you will find that this information is given. Now step 2. In the step 2, we are going to calculate the normal earnings. This is the step 2. We are going to calculate the normal earnings, and how to do that. First, we should have fair market value of the asset. It is given in the question. Then you have to read the question to find out what is the fair market value of liability. And based on this two information, one of the most important point here is to calculate the net asset. Why the net asset is important? Because look at the formula. When we determine the price of the asset, in the last step, we should have net asset plus we should have the goodwill. So we already know how to calculate the net asset. It is fair market value of asset minus fair value of liability. So here, $3 million, okay, is the net asset. Then we are going to calculate the normal earnings. How to do that? This is the net asset times return on asset. So according to this question, return on asset is 10%. So return on asset is 10%. So our normal earnings, is $300,000, right? So this is step 2. Then step 3, we are going to calculate the expected future earnings. For example, this is 2023, right? And we are going to calculate the expected future earnings for 2024, something like this. So this is the things we have to do here. We are going to calculate what is our expected future earnings in the coming year. And I told you that in the real business world, this to calculate this amount is not easy. Okay, in the real business world, to calculate this amount is not easy. We need to do a lot of adjustments. Okay, we need to do a lot of adjustment to calculate this number. And one of the important factors we have to consider for non-recurring gains and non-recurring losses. So I told you in the last class, this is a one-time event. This is one-time event. So this event will not happen in future. So as this event will not happen in the future, we are not going to consider this information, okay, for the future expected earnings, because it is already happened. It is already happened, and there is no chance to do it again, happen it again and again, okay, because it is one-time event. So you have to read the question very carefully to find out whether you have any non-recurring gain or non-recurring loss, because this is the one-time event. Now, this is our expected future earnings, okay? So some question you may not have this kind of adjustment. I can easily give you the expected future earnings, okay? Anyway, so if we need adjustment, we should do adjustment. For these examples, we don't need any adjustment because the number is given. Anyway, then we are going to calculate the excess earnings, and we already have expected future earnings. We already have our normal earnings. The normal earnings means the regular earnings. So this is our regular earnings normally happen, and these earnings we are expecting for future. So we are going to calculate the excess earnings. So we calculate excess earnings. How? First, in order to calculate excess earnings, you first have normal earnings that we calculated from step 2, and we calculated expected earnings from step 3, and this is the formula. Expected future earnings minus normal earnings, it is $100,000. This is our excess earnings. After that, when we will have excess earnings, then we have to find out some keywords from the question. Which are the keywords? For example, this is one of the keywords, that this expected earnings. So this expected earnings you are expecting to earn in the coming year, right? Coming year. So this is your expectation. But how many years you are expecting this kind of excess earnings? If you are thinking, or if you assume that this expected earning will have indefinite period of time, okay, then we have a formula like excess earnings divided by discount rate. So what is the meaning of discount rate? This is the market rate. For example, you don't want to buy a company, but you want to invest your money to a bank. How much return you will receive from the bank? Okay, this is called market rate. Discounting rate means market rate is the investment rate you are expecting if you invest your money. Do you understand? So this example, we are going to buy another company, but if you don't buy another company, you can invest this money to any place. And what should be the return? This is actually the market return. So excess earnings divided by the discounting rate will give you, it is $5 million or $500,000, 5 million. Anyway, so if we do this, then we can get the estimated goodwill. Okay, we can get our estimated goodwill. Maybe $500,000. Okay, so we may have estimated goodwill like this. Then you find another word. Maybe this word is not available. Indefinite period of time is not available. There is a limited period of time. That means 10 years. That means you are expecting to have this kind of excess earnings for coming 10 years. Okay, so it is given a fixed year. If this is the case, we have another formula: excess earnings times the present value of ordinary annuity factor. And I already shared the present value table with you. By using this table, you can easily calculate what is the factor for 10 years. This is the discounted rate or market rate. And we are going to use this table. We can find a factor here. And this factor multiplied by the excess earnings, you will get the estimated goodwill. And this is the things I told you, that price is determined by net asset. Okay, net asset plus our estimated goodwill. So if we add this to, then if we add this to 3 million and 5 million, anyway, this is 8 million. Or this is maybe 300,000. And this is 500,000. and this is 800,000. So this is the case, something like this. Now, let me explain one question so that if we solve a question, it will help you to easily understand the subject matter. So let's read the question. So Plantation Homes Company is considering the acquisition of condominiums incorporation in early 2007. Okay, so they are considering to buy this company in the year 2007. I assume that this is the coming year. So they are going to buy this company in 2007. To assess the amount it might be willing to pay. So now, as you already decided, so you are here, the Plantation Home Company, for example, this is the parent company. This is the parent company. So assume that this is the parent company, Plantation Company. And you are going to consider to buy condominiums incorporation, and it is something like subsidiary company. So this is your plan. You want to buy this. Now, as you have a plan, you should do some calculation. What should be the amount you have to pay to buy this company, right? This is the things we are going to learn actually. So you decided to buy one company. Now it is your responsibility to make some calculation. What should be the price to get this kind of company? You have to calculate this. So to assess the amount it might be willingly to pay. So we are going to calculate what is the amount we are willingly to pay. Okay. So the parent company is considering the following assumptions. So you understand the introduction paragraph, right? Now look what are the information you are going to collect. So you search the information from condominiums incorporation asset. So identifiable asset with total fair value is $7 million. So this is the fair market value of asset. Okay, you search the balance sheet of the target company, and after searching the balance sheet of the company, you estimate that the fair value of their asset is $7 million, and the fair value of their liabilities is $3.2 million. Okay, so you calculate this information. So can you remember why we need these two information? Why we need their fair value of asset and why we need their fair value of liability? Because we have to calculate net asset, right? We have to calculate net asset that we have to pay. Thank you. Then the assets include office patent and copyright with a fair value approximating the book value. So what is this? So this is one, they search that they have one asset title is office patent and the copyright. So this is their asset, and they figure out that the fair market value, okay, the fair market value of patent and copyright equal book value. Do you understand? So they said that this asset include office patent and copyright with a fair value and approximating the book value. That means the fair market value is equal the book value, right? If you have this information in any question, so you no need to think too much. If this is the case, okay, no need to do any adjustment. So why we no need to do any adjustment for this kind of asset if fair value equal market value? So you have to read the question very carefully that whether we do need any adjustment or not. So if any asset fair market value and the book value equal, okay, then we no need to do any adjustment. What about land? Okay, What about building? And what about other things we are going to see? So they said that buildings with a fair value, 50% higher than the book value. Now we find another information. Fair market value of building, okay? Fair market value of building is higher, is greater than the book value. Do you understand? So fair market price is higher and book value is lower. So we need adjustments. So we need some adjustments for this part. Why? Because fair market value is higher. So this is one point. Then we have another information about equipment. Equipment with a fair value 25% lower than the book value. So again, we find that fair market value is lower than the book value. We need adjustments. We need adjustment. So from this part, anyway, we have another sentence here. The remaining lives of the assets are deemed to be approximate equal to those used by the company. That means they said that the remaining assets actually do not have any change. Okay, they are in constant. They don't have any changes. Equal situation. Equal means fair market value and the book value similar. Okay, they said that it is equal. So if we know that if there is equal, okay, if there is equal, we don't need any adjustment, right? So as we already know this, so they say that their other assets are equal, so we don't need any adjustment for this part. So this is the things we should consider. And as we are going to buy this company in coming year, so we are going to analyze their previous year's income, right? We are going to analyze their previous year income. So this is the previous year before buy this company. So we received only 1 year information. So we may have last 5 years data, or we may have last 10 years data. Okay, we should analyze. So this question they tell us that we have their pre-tax income information for 2006, something like this. So we have only 1 year data here according to this question, but your future question may not be 1 year, maybe 2 or 3 years, something like this, or 5 years. So the following are included. That means this information already included to calculate this pre-tax income. Do you understand? I repeat again, the following are included in pre-tax earnings. So these items already included here. Now, this is 2006 information, right? We are going to calculate future earnings for 2007, right? And we are going to do some adjustment because something happened 2006, but something may not happen in 2007. Okay, so what will not happen in 2007, we are going to adjust. Clear? Now let's see if we explain here. I add another column. So try to understand how we can do the adjustment. So if you don't understand, please stop me anytime. This is the important part. So amortization on patent and copyright. So amortization means one kind of depreciation, you know that, right? So in case if it is, we have two types of asset, tangible and intangible. If it is intangible asset, we use the term amortization. If it is tangible asset, we use the term depreciation, right? You learn this from your intermediate accounting. Anyway, so according to this question, in case of amortization of patent and copyright, we find that this is the case. This is the case. That means in case of patent and copyright, book value and market price is similar, right? So no adjustment. No adjustment for amortization of patent and copyright. Okay. But here we find that depreciation on building, we need adjustment according to this question. Depreciation of building. So this is the building. This is the building. So building fair market value is higher and book value is lower, right? Fair market value is higher and book value is lower. Now this is the building. This is the building. Try to understand. Fair market value is higher. What is the percentage? 50% is higher, right? Fair market value 50% higher. It means that the value of building increase, right? If value of building increase, then depreciation expense will increase or decrease. The value of the building increase, depreciation expense will increase or decrease. What do you think? So building value increase, right? When we do calculation for depreciation expense, so depreciation expense will increase or decrease? Increase, very good. So this depreciation expense will increase in 2017, right? 2017. Because we already calculate pre-tax income and this market price increase. So we are going to assume that as building increase 50%, so depreciation expense will also increase 50%. So here 360,000 times 50% equal 180,000 maybe, right? Yes, so we think that this $180,000 depreciation expense will increase, okay? When? In 2007, because we are calculating the expected future earnings. So according to this data, so we are expecting that in coming year, 50% of depreciation expense will increase. So if depreciation expense increase, how it affect to the net income? In 2017, net income will increase or decrease? Decrease, very good, decrease. Yes, thank you very much. So this is the case. So we find that in coming year, depreciation expense of building will increase. So we know that if expense increase, our net income will decrease, right? That means in 2016, we not have this money, right? It will be this amount lower. Another point we find that for the equipment, this is the equipment. We find that equipment fair value will decrease, lower, right? Lower means decrease. It will decrease 25%. 25%. So this is the equipment. This is the equipment. Now we do some calculation. This is the current year depreciation expense, right? This is the current year depreciation expense, and we are expecting 25% equal $20,000 will decrease, right? So equipment value decrease, it means that depreciation value will also decrease. So if your depreciation expense decrease, okay? So here I can, so this is increase. This is increase, so, and this is decrease. If in future your depreciation expense decrease, that means in future our net income will increase or decrease. Also decrease or increase? Increase, yes. Yes. So here decrease means minus, okay? Decrease means minus and increase means plus sign, right? Yeah. So we find that for this amount, we find that one amount means $180,000. $180,000. This is decrease, right? Or I can use this sign. So decrease 180, right? Plus increase $20,000. So up to here, we find this information. Up to here, we find that this is the current year pre-tax income, but in future year, our income is going to decrease by $180,000. But in future year, our net income is going to increase by $20,000, right? Based on these two information. Now look at the third one, extraordinary gain. I told you that this is one-time event. That means this event will not happen in future anymore. So because of this gain, look at here, because of this gain, and gain already included where, according to this question. Question said that gain or loss or everything is already included here, right? Already included here, this gain. This gain increase this amount or decrease this amount? Because of this gain, it is included as a plus sign, right? Do you understand? This gain already included here as a plus. But this gain will never happen in future because this is one-time event. So in future, if it will not happen again, how do you think? Your net income will increase or decrease in future? Decrease, very good. So, very good, net income will decrease because it will not happen again, right? So look at here, minus $250,000. This is minus. Clear? Then we have another one-time event. We have another one-time event. This one, the next one. We have another one-time event. Loss on discontinued operation. So this loss is already included. Look at here. This loss is already included here as a plus sign or minus sign. The loss on discontinued operation is the one-time event, and it is already included $1,059,000 as a plus or minus. As a plus or minus, you don't know? Why plus? Loss is the minus. Because gain is going to add, right? Gain is added. Gain already included here. And loss also included here. So gain we use plus sign and loss we use minus sign, right? So this loss already deducted from here, right? Already deducted. But this loss will not happen again in future. So what you will do? Plus, yes. So net income will increase. Net income will increase. That means this money is going to add it back. Okay. This money is going to add it back. So plus $175,000. Okay, $175,000. Now pension expense $259,000. Nothing is mentioned in the question. Usually this is the regular activities. Okay, this is the regular activities. Every year company have to pay the pension expense. So it is not going to adjust it. Okay, it is not going to adjust it because it is already included here. And in future, this kind of pension expense will have again and again, like salaries expense will have again and again, right? Interest expense will have again and again. So this is meaningless. So this is the adjustment. This is the adjustment we have to do. This is the adjustment we have to do. So I just explained the question. I haven't shown you the solution. So I told you that when we calculate the expected future earnings, here, I told you that when we calculate the expected future earnings, we need some adjustments, right? We need some adjustments. So this is the adjustment based on the question. Then the normal rate of return of net asset is 14%. So they said that this is the company and their normal rate of return on asset, ROA. This is the ROA. Is 14%. This is the step one, right? This is the step one. And they said that assume that the plantation homes feels that it must earn 15% return on investment. That means if they do not buy any company, they can invest their money to any other place and they can earn 15% return. And this is the market rate. This is the mark. So this amount is the market rate. Or we can say discounted rate. Discounted rate. So this is also given in the question. Market rate and discounted rate is given. So not a big issue. Return on asset is given. And I told you that this step. So when we calculate excess earnings, we must have one assumption or two assumptions. That means this excess earnings will last unlimited period of time. Okay. This excess earning will have unlimited period of time or a limited period of time. So you have to read the question whether it is unlimited or limited. So it is mentioned here, but the excess earnings are to be capitalized for 7 years. 7 years means we have to calculate the present value, right? We have to calculate the present value of ordinary annuity. Yes, to estimate the goodwill. Yes, so ignore the tax effect. We are not going to consider the tax effect. Then we are going to calculate how much price should we expect to pay them. Now I can go through step by step and you can solve with me so that we can easily understand every step. So you remember that the first step is determine ROA, right? Determine ROA, and it is given. According to this given, it is 14%. 14%, no problem. Then we need to calculate normal earnings, okay? To calculate normal earnings. So this is the last step. We have to calculate the normal earnings. Not last step, last part of this step 2, normal earnings. To do so, we need to have first fair market value of assets. We need fair market value of liability. So I told you that this information is given in the question, right? Then based on this information, we have to calculate net assets. So net assets columns are one of the important columns you have to remember, because we'll use this. Sorry, we will use this in future, right? We will use this amount in the future. So I make it color. So anyway, the question we can copy and paste from the question. Fair market value is given $700,000. Then fair market value of liability is given. The net asset, it is something like asset minus liability. It is 3. This one. So what is the formula of normal earnings? Can you remember? It is something like net assets times ROA, right? Yes, this is the formula. Net assets times ROA. This is the formula. So we need ROA here. It is 14%. And the amount is here $532,000. So this is the normal earnings, right? Okay, so now we have to estimate the future earnings. We have to estimate the future earnings. So I can copy this one from here that I will explain to you. Yes. So we can use this information to solve this part. So we have pre-tax, you can see that pre-tax income for 2006. This is 2016's pre-tax income, and the question said that it is this amount. So question said that pre-tax income is this amount. Now you can see that this one minus $180,000 minus, right? Why minus? Because in future, the depreciation expense on building will increase. If depreciation expense of building increase in future year, then then our net income is going to decrease, right? Sorry. So minus, we can see that, or we can. So additional depreciation on building is going to deduct from our right. So I can put first bracket to make it more easy for you. So this is going to decrease. Then we find that in future, our depreciation expense on equipment is going to decrease. Reduction so in future, our depreciation expense on building is going to reduce, right? So our net income will increase. So it is $20,000. It is $20,000. So I think you understand up to here. Then I told you that we have extraordinary gain. We have extraordinary gain. This will not happen again and again. So this money will not have in future, right? This money will not have any gain future. So extraordinary gain. So it is $250,000 is going to deduct. This money is going to deduct it. Then we have non-recurring loss, that means discontinued operation loss, and this loss will not happen again in future. So if you in future you do not have this loss, it means that in future you will have more money. So this is add. This is extraordinary loss. So $175,000 is going to add. So this is the case. And after that, by doing this plus and minus, we're going to get expected target earnings. This is the earnings we are not this one. This is the case. The amount is $824,000. So this is our expected target earnings. Okay, these are expected target earnings. So do you have any question up to here? So we know our rate of return. We know our net asset. We know our normal earnings. So normal earnings we already have. And we already have our expected earnings. Okay, so we already have our expected earnings. So this is the expected earnings. Minus expected earnings minus normal earnings. And our normal earnings is this amount. So this is equal. So our excess earnings is $292,000. $292,000. This is the excess earnings. Now I told you that if you have mistake in a step 3, okay, if you have mistake in a step 3, then you have chance to do mistake in another steps. So this is step 3. If you have mistake here, step 4, 5, 6 also mistake. Okay, so step 4, we already calculate our excess earnings. Now we have to read the question. I told you that we have to read the question to see how long this excess earning will last, right? If it is unlimited period of time, then we have one method. If it is a limited period of time, you have another method. So according to this question, we will have this for 7 years only. So we have 7 years only. So how to do that? We have excess earnings. This is our excess earnings. And it is going to multiply by the factor. We're going to multiply the factor. So how to calculate this factor? We're going to use present value of ordinary annuity, right? 7 years. 7 years, and we have what is our discounted interest rate? 15%. 15%. So this factor we have to find out from our table. The table I already shared with you. So you have to see the table to find the factor. And the factor here is, so the factor here is 4.16042. So this is the factor. This is the factor. Then we find the estimated goodwill. Estimated goodwill, and it is 1214843. So this is our estimated goodwill. And you know that from the very beginning, I told you that how to determine the price. This is the formula. We need net asset and we need estimated goodwill, right? We need this information to, and now we have all the information. Now we have all the information. We have net asset. We have estimated goodwill. And it is and this is the price. Do you have any question?